Takes us to our top story. For several weeks, North American investors have been increasingly worried about the fate of the U.S. economy as the Trump White House pursues an aggressive tariff policy with many of its global trading partners, including, of course, Canada. There's been no shortage of economists predicting that the tariffs, if in place for a meaningful length of time, could induce both slower economic growth and inflation in the world's largest economy. But if U.S. Fed Chair Jerome Powell saw yesterday's Fed announcement as an opportunity to raise the alarm over such fears, he, in the words of our partners at Bloomberg News, quote, took a hard pass. Instead, he said the inflationary impact of tariffs is likely to be, quote, transitory, a word investors have heard before. And the Fed dot plot forecast shows most Fed members see 2 rate cuts coming this year. Lots to talk about, so let's do exactly that with our featured guest of the morning. He's Kash Pashootan, CEO of First Avenue Investment Counsel. Kash, first of all, thanks for coming in.
My pleasure, thank you.
So what do you make of this? What do you make of the rally yesterday in particular, clearly driven by a more optimistic Fed outlook than many investors were fearing?
Yeah, it's certainly nice to see some optimism come into the picture, given what investors have experienced over the last several weeks. I think what we do know, and I wouldn't place too much good or bad emphasis on a single day's trading session, but what investors should expect as we move forward here is increased volatility. I mean, I think regardless of what your view is, we all have to agree that we're in an environment that the VIX will be trading at higher levels than we've experienced. Overall volatility is going to be considerably higher. And in some cases, you know, we're so quick to attach reasons as to why there's more volatility. But the reality of it is, when we look at the stock market over a 50-year period, what we're experiencing is very natural. It's very cyclical. There's always a reason why volatility comes back. But I think as investors, it's less about the reason and it's more about just reminding ourselves of the characteristics of investing in equities so we have a successful overall outcome.
What do you think of the correction that we've seen so far?
I think it is scary, you know, from an investor perspective, because you have this tariff scenario, you have an ally that now doesn't feel like an ally. So there's lots of reasons to be scratching your head and wondering what's the future look like. But if we look at just purely the numbers, we're coming off of a couple of blockbuster years in the equity markets, whether you were invested in Canada or the US. Let's not forget last year, market investors saw returns of anywhere between 15 and 30%. If you were more in dividend paying stocks, you were in that 15% camp. If you had the Magnificent Seven and more growth stocks, you were closer to the 30% camp. Yeah. So when you look back, if you have a year where the market gave you 15 to 30%, it should not be surprising that the year after there's volatility, potentially not exceptional returns, and we're experiencing that. So, you know, for us, we remind investors, we remind clients that yes, absolutely, our job is to focus on what's going on and why it's happening. But if you take a step back and just look at the characteristics of the equity markets, to have a correction after a year and 2 years where the market's giving you the returns that it has, that should not be a surprise to anybody.
And so what should investors be doing now, if anything, with their portfolios?
Well, I think the first part, yeah. So what I would say is to take a broader view. And what I mean is not about the future, even the past. Take a look at the last 10 years. Take a look at the last 20 years. If you look at the last 25 years, you'll see that a 10% correction on average has happened at least once. So when we look at and study the characteristics and the history of the market, I think it helps investors set themselves up to be successful for the future. So I think that's one point. I think the other point is, let's look back at what the markets did last time Trump was in power. And the Canadian markets had a good run. The US markets had a good run. So positive returns in Canada and in the US. So we do think that reason will prevail. And although there's a lot of threats and posturing going on, the Trump factor will play itself out. I think overall, in terms of looking at the markets, the other factor that, again, if you're looking in the future, you have a few things going for you. Number one, if you're a Canadian investor, the Canadian dollar, and we're going to talk more about this later, is weak. And so as it strengthens on the exchange, there's money to be made just on that part. The other part is we're in an environment where interest rates are expected to go down. And so that helps businesses. But also, let's not forget, it drives capital back into the equity markets. You know, a year and a half ago, when you could buy a 5-year GIC and get almost 5.5%, the idea of buying a dividend-paying stock wasn't as compelling.
Right.
Today, a 5-year GIC is around 3%, and it's going to be at 2.5% before you know it. So that also pushes fixed income money or savings account money back into the market, and we shouldn't underestimate the impact that will have in terms of positive on the markets.
That's Kash Pashootan, and on yesterday's rally and the markets more broadly, and how